Welcome to today's episode of Peak Market Watch. We speak with market leaders in commercial real estate and related services who have a close pulse on the current market environment. My name is Anton Mattli, co-founder and CEO of Peak Financing. I'm honored to welcome Sandhya Seshadri, founder of Engineer Capital as well as ACE Operators. Sandhya has been a multifamily investor, and her firm ACE Operators helps other multifamily owners to improve their asset management, which is, as we all know, now a more important than ever thing to do to get through the current high interest rate and high inflationary environment. Welcome, Sandhya. It's a pleasure to have you with us today.
Thank you so much, Antoine. I've watched you from a distance for several years now, and it is such an honor to be here on your podcast.
Yeah, it's great to have you on. Why don't you share with our listeners a little bit about your background before we dig into deeper into multifamily asset management?
Thank you. Like most Asian geeks, I have a strong background in math, and so I have an engineering degree. Came here to college at Dallas SMU several years ago with two suitcases in hand, like many immigrants. Because of a scholarship, I was able to go to college and then started working in Texas Instruments, so engineering career, project management, program management, underwriting, etc. Because of also getting my MBA. Then I traded stocks for many years. And I found myself in real estate only to look for something that would help offset my taxes and have a piece of real estate without doing the four T's, the tenants, toilets, trash, and termites. I attended a weekend event, seminar about large multifamily and jumped in with both feet. I used my retirement income to invest passively, and then I joined other experienced partners to invest actively. And now I'm a lead general partner. All my deals are in Dallas, where I've lived for over 3 decades, and I really know this market. And so this is where all my deals are.
Yeah, very good. So you mentioned that initially you started out as a passive investor just
Mhm.
to learn the ropes, right?
Mhm.
Yeah.
Yeah, I highly recommend that. I think of it as an airplane journey. You first start out as a passenger on the flight before you choose to become the pilot. So I did the passenger, which is passive investing, and then I did the co-pilot, which is being a GP, joining others with more experience. And then now I'm the one doing that, as leading these deals and then bringing in others to learn the business along with me.
Yeah. Uh, uh, Multifamily investing, unlike single family investing, where very often you can do it all on your own, right? And there are many people that do that and do it very successfully. But as you mentioned, it's a very time intensive
Mhm.
type of business, and it's very difficult to scale. Whereas on the multifamily side, it's you can rely on a team, right?
Mhm.
And that team involves obviously multiple people, and we can touch on that a little bit later. But I think, based on what I know about your story, you were essentially part of that team, and that's how you got into the GP side, if we call it, or sponsor side of the business by offering your expertise to investors that wanted to buy in Dallas but didn't have a presence in Dallas. So maybe you can touch on that, how you got involved for the first time on the sponsorship side.
The way I got into my first deal is by, you have to have something you offer to an experienced team to make it worth their time to mentor you and guide you. And in my case, I found two partners from out of state, and I was the local expert of the DFW market. They were looking to come into the Texas and DFW in particular. And so I was able to be sort of the brawn or the person available to them anytime that something was needed. If a vendor was going to show up to the property the next day, I could be on site. So this saved them the trouble of making those trips, but I could do lives with them and I could tell them what exactly was going on. And we did this in 2019, and then 2020 COVID hit and they could not travel as much. So I really became the local boots on the ground asset manager, doing all the discussions of the value add proposals with the vendors, property manager, and all of that. And so that became my wheelhouse, and that's what I specialize in, if you will.
Mhm. Very good. Uh, Now let's touch a little bit more about that role, right?
Mhm.
'Cause obviously, a lot of people feel once you move up from single family and you don't have to do your own property management, you hire a property management company. So now you are essentially hiring a third party, and you can go to the beach and manage them from the beach or wherever else in the world you want to be. And I would say that may have worked in 2012, maybe to 2015, when the prices were so low for multifamily properties that you could make a lot of mistakes and you still make money.
Mhm.
In the current environment, over the last few years, that's only no longer the case. And proper asset management is such a crucial piece to success right out of the gate. So maybe you can tell our listeners a little bit more what asset management actually means, and the differences to property management, because a lot of people feel, well, I hire someone and then they run my business, which is definitely not the case.
Yeah, we're talking about large multifamily syndications. You're talking 20, $30 million kind of deals, and it requires a lot of investors' money. So you are essentially responsible for other people's money to buy these properties. And so you have to be a good steward of that. And you can't depend on a property management company to do it all by themselves. This is a much larger scale operation, and it requires a commitment and a close I guess, monitoring of all the KPIs, etc. But the big picture of it is, if you are a syndicator and you have 50, 100 investors on a deal who are depending on you to execute the business plan, you can't really make mistakes, because in a single family, your mistake might only be $2,000 or $3,000. Here, everything is multiplied. You've got 100, 200 doors. So you need to be aware of who the stakeholders are. That's the first thing I would say. And the first biggest owner of your property is actually your lender. They are the boss. They control 60, 70, 80% of your deal. So you do whatever they say. And a lot of people forget that. Your property management company isn't thinking about the lender. They're very tactical in doing the day-to-day operations, such as the leases, the renewals, the evictions, the work orders, etc. But the asset manager has a more strategic role in balancing all the different stakeholders. The first one, as I mentioned, is the lender. You do whatever the lender says. When you're signing a large loan and they come to you with lender required repairs, some are immediate repairs, you need to be aware of that list, and you need to comply with everything that is in your loan agreement. Because if in any time, as you know, Antoine, if you're not compliant, they can have all kinds of additional clause and control by which they can take over your deal. So never forget that. The second piece is your city code compliance. And ultimately, as the general partner in the manager LLC that buys the property, you are responsible for anything that goes wrong, not the property management company. You're the one who's going to be in trouble with the city. The city can shut you down if you don't do the things that the city code compliance asks you to do. And that varies from city to city. So that's your second boss. The third one is insurance. You must be compliant with insurance requirements. So my properties are in Dallas, so they're not really by the ocean, etc. So I don't really have a floodplain or those kind of risks, or I'm not in Houston. But if your property is near a creek, it's near a lake, it's any source of water, you might have several buildings in there. So there's a lot of little things to think about when you underwrite these properties and then manage them later. So your insurance company might have had a different requirement for compliance 3 years ago versus today. Like, for example, the railings in a balcony, they need to be spaced now 4 inches instead of 6 inches, or even the height of a balcony. So you need to be aware of insurance requirements and address those immediately. So that's your three stakeholders that are very important to keep in mind. But then here you have your customers, and that's number one is your resident. Without them, you wouldn't be in business. So make sure your business plan aligns with your residents. So what kind of things, amenities do they appreciate? What are their care abouts? And that could vary depending on the location of your property, the demographic. Are you trying to attract the white collar worker who just graduated from college and is living in your nice A-class apartment? Or is it more of the workforce housing, the 50, 60K annual income kind of families? They care about the schools and parks, and they don't really care about a splashy pool, or they do, right? You need to really understand your residents. And then your customers is also your investors. What do they care about? What kind of communications do they need? Why, when do you update them? What type of reporting do you do to them? And at the heart of it all, I kind of use it like my hand method. You got your 5 stakeholders: your lender, your code compliance, your insurance, and then you've got your residents and you've got your investors. But at the heart of all of it is you and the property management working together cohesively with clear communication and what needs to happen. So they are the tactical piece to execute your plan, but you still need to have checks and balances to make sure they are executing to what that needs to be. What are your financial targets? What are your occupancy targets? What are all those KPIs that matter so that you are all marching on the same beat?
Excellent overview, right? Obviously, there are so many more
Mhm,
details for each stakeholder to consider, and I think the core element here really is that you have
mhm,
5 core stakeholders,
mhm,
and they all have their own requirements. They pull in their own direction, and they want something from you,
mhm,
right? And very often, what they want is in conflict with what another stakeholder may require. So, as a asset manager, you really need to be able to balance all these demands and requirements, and still keep everyone happy, right? So
mhm,
it's a very difficult job, and I think a lot of people underappreciate that. And when we look at some of the deals that are in trouble now, obviously everyone talks about high interest rates,
mhm,
are causing a lot of headaches, and there is no doubt about that is
mhm,
the case. However, when we look behind the scenes, very often a lot of these properties are in trouble,
mhm.
not just because of high interest rates, but because of lack of proper asset management, right? Uh, Now, can we talk a little bit more about each of these stakeholders where you have some core recommendations, what some of the key items are, what you really need to focus on?
Sure. The lender is the first piece, the most important. They own the property, really the bulk of the property. So you have to comply with their requirements. And it really helps to have a relationship established with your lender and lender broker to understand the nuances for each lender. So let's say you have Fannie or Freddie. Their careabouts and the things they look for can be different, and their requirements can be quite different than when dealing with a bridge lender versus a CMBS, a commercial mortgage-backed security. So it's important to have a lender broker such as Antoine that you can work with closely, who understands what you plan to do and then can find the best fit for you. But once you have that lender in mind, let's say it's Fannie or Freddie to start with, they look at your trailing 12 months to award you the loan and what is required for it. As an asset manager, then they give you a list of lender required repairs and deadlines by when you need to do them. And they also tell you what kind of DSCR, debt service coverage ratio, you must meet, and occupancy. So, as an example, a bridge lender might be okay with a lower occupancy, knowing that they are a bridge for you from the current state of where the property is to permanent financing. But a permanent financing lender, such as the agencies Fannie and Freddie, they would require you to maintain that 90% occupancy. So, what do you have to do to maintain that? So, if you have a large number of leases expiring, for example, all at the same time, and let's say those tenants move out, that's going to be a challenge for you. Your occupancy could drop. So, you want to make sure you get those renewal notices sent out early. You want to make sure you are taking good care of the existing residents so they renew. And you want to make sure you try to stagger those leases or spread them apart so that you don't have the same problem again a year later when you come to the same situation. So your vacancy doesn't, increase drastically because you have a large number of move outs all happening at the same time because of the lease expiry. But that's just going down one rabbit hole with one lender. So it's really important to know at a high level the terms, and the most important criteria for each lender, which is always the debt service coverage ratio, the occupancy, and any kind of repairs. Some lenders give you notice, most of them for their annual inspection dates, etc. But sometimes they don't, that they may just show up. And so you really need to be making sure whatever they gave you. Some of the lenders give you money to do some of these capital projects, like go repair your parking lot, it's unsafe, or go repair the stairs or railings or something else. Especially when they loan you the money to do these capital projects, you want it documented before and after. You want to have pictures. You want to comply with that and send it to them on time. Do not be late, and do not come to them on the last day when something is due to say, oh, I'm still getting bids, we have not even started the work, right? Get yourself that extra time if you need it. Start negotiating with them if you need an extra 2 weeks or 3 weeks to comply. But anything that affects the safety and quality of life for your residents, such as air conditioning, heating, all of those things, they will come and ding you on that. So make sure you take care of those things as a lender.
Yeah, very good point there. Maybe what I also would like to add is, right, if when you, particularly with the agencies, obviously, if it's a bridge loan and you have a ongoing rehabbing going on, everyone acknowledges that the property might be in some form of a distress for a certain period of time until you restabilize it. With the agencies, that's not really the case, right? So they expect that you keep the property stabilized throughout the term, including the condition of the property. And I think a lot of owners do not realize that if once they do an inspection and they're not happy with you with that property, that may have an impact on your future ability to borrow from a Fannie or a Freddie, right? Once you're on their list as an operator that doesn't really take care of their properties, it's very hard to get loans in the future. So it's not just about one single deal, it's really about your reputation with lenders and the agencies. So it's important to keep that in mind too.
Excellent point. The next one is your city's code compliance department. I live in the Dallas area, and there are so many different smaller cities, suburbs, metros, etc. within DFW, and the requirements are different. So I have properties, across Tarrant County, Collin County, Dallas County, etc. And every city within those counties is different in its code compliance requirements. And it really helps to have a local property management company already managing a property in that particular city with a strong relationship with the code compliance department. But they do their inspections as frequently as they want. Sometimes they give you plenty of notice. Sometimes they'll say, well, I was inspecting the property next door, so I decided to come and check on this. And they will also give you dates and deadlines to fix certain things. And you want to make sure you comply with that, because especially if it has to do with major things like hot water, sewage, air conditioning, any as far as hazards, trip hazards, handicap parking spots, speed bumps, stairs, railings, those kind of things. And then, of course, fire hydrants, fire escapes, fire extinguishers. Those little requirements vary from city to city, and they'll give you that list, and you want to comply. You want to do it well on time. You want to just be, very polite and respectful when those inspectors show up to your property. You want to make sure your team is ready and waiting. And sometimes as a general partner, I will try to attend and be there when this happens, just to let them know, look, this is important enough and serious enough that I'm here, and I'm here to listen. And sometimes we'll walk with the maintenance, walk with a bucket of, these smoke detectors, etc., because some residents will pull those off, and then it'll be an unsafe condition for which you'll fail the inspection. So we'll say, look, we got it right here, and look, this resident has pulled it and put it in the trash can, kind of things. But you want to have a very strong working relationship with your city code compliance, because without them, you could be shut down as a business and have to pay for all your residents to go live in a hotel. So that's pretty dangerous.
Yeah.
The third stakeholder, did you want to add anything to that?
Yeah, so just wanted to add to some simple things that would be so easy to monitor, but we have seen it even with properties where owners invested uh, thousands of dollars in rehabbing the units and the property. So sometimes millions that they invested in the property, and then we walk the property, and multiple units have fire extinguishers that are expired, right? So
Hmm.
simple things like this is a
Hmm.
typical case of lack of asset management, right? Yes, you can argue the property management company is in charge of it, but you as an asset manager, you are in charge of making sure
Hmm.
that the property complies and watch that the property management side does what they're supposed to do, right? And again, simple things like this, if it happens once, then the city is a pretty tolerant. But if it happens again, you are on their blacklist, and then
Hmm.
everything else gets harder, right?
Correct. So one thing we do as part of the GP team is we try to walk the property and go through that punch list about a week prior to those inspections, so that the property management company also knows that we are taking this very seriously. And this is, it's not a choice. You must comply. When it's the lender, the city, as well as the insurance company, it's not optional. It's a must do. So let's do it. And then with insurance, that's the thing, is what might have been okay a few years ago may not be okay now. And it's in that insurance contract. And all of these contracts, like whether it's from your lender, your insurance company, etc., they're not the easiest to read. So you again want to have a middle person, like an insurance broker, who can interpret that for you and make sure you have a very clear punch list and the deadlines by when those things have to happen, because otherwise they won't insure you or it won't be valid. So when you file a claim, they won't pay because they said, well, you didn't do this. So that's why you'll have to pay for it yourself. And then if you don't have insurance, then you're in violation of your loan agreement as well. So those are three things that, lender, insurance, and your code compliance. There is no optional. You must do them, and you must do them first. And this is where the whole planning and budgeting comes into play, is that right up front, you may not know what this list is from these three stakeholders. So always have plenty of CapEx and cash left. Know what the three requirements are and budget for that first before you go spend all your capital projects doing something like, oh, exterior paint is going to cost me $200,000 across, this many buildings. But I also need to repair the parking lot, which is another 200K. I need to change over my balcony and railings, which is another 50K, etc. And it keeps adding up. And so you need to be aware of your CapEx budget and plan some money just for deferred maintenance items required by these three stakeholders. And then you've got your residents. What do they care about? Like, do they really want you to put a pickleball court? Okay, does this resident demographic care about that? Or do they just want you to have some additional staff at hand to, when you take over, to make sure all these work orders are taken care of? Let's go spend the money to replace that air conditioner instead, or fix those leaks, or whatever else has been a complaint by these residents in all of the Google reviews you read about this property. What's the biggest thing they said that has not been fixed? Go do those first, because that's what's going to help you with renewal, retention, positive reviews, to attract more good residents to your property. So add amenities that really is something they value and are willing to pay for. Washer dryer connections is always a favorite. Adding washers and dryers is a favorite, because laundry is an expense anyway. So in Texas, in August, it gets pretty hot. So imagine taking a whole laundry bag with little kids, and you're, a single mom going across the building to this laundry center to do all of your laundry. You would much rather have the convenience of washer dryers in your unit and pay extra for it. So think about amenities that residents appreciate and will pay for and will feel glad that they're living in your community. I mean, happy customers is what you need for any business, and residents are your customers. Never lose sight of that. And then, your investors, they matter, because without your investors, you wouldn't be in these large multifamily deals. So make sure your communications are clear and they're consistent. And if anything is different from what you projected to them initially, tell them why. And if it's a good positive thing, yeah, mention it. But especially, let's say you have to stop distributions, or let's say your expenses increased because something happened at your property. Very clearly explain to them why the distribution amount is less or why it's stopping. Maybe you had a storm, you had burst pipes like we did in Feb 2021 in Dallas, where we had 9 continuous days below freezing, right? Explain to them what happened, tell them what you're doing about it, and let them know that you are doing everything you can to mitigate the risk and take care of the current situation. But be clear in your communications. You are required to financially report to them monthly. Make sure the reporting is clear, and you show the charts that compare your initial projections to where you are today and what you are doing about it. That's crucial. But at the heart of all of that, right in the middle, is your on site staff and your property management company. Whether you are vertically integrated or you have third party, make sure that on site staff understands why something matters, because they get paid 50, 60, 70K kind of salaries, and you have millions of dollars at stake depending on what they do. So tell them why that retention is important. Tell them why maintaining that 90% occupancy is important. Tell them how the little things they do at the property with customer satisfaction and compliance affect you. So they see the big picture also and are marching to the same tune. And then if you are general partners, right? Most of our general partnership teams, it's a team sport. If you have 2, 3, 4, 5 general partners, make sure you have one main spokesperson so that the communication is unified. It's one clear message to the on-site staff to execute on your strategies and how to prioritize that list, especially in the first 30, 60, 90 days of takeover. It can be a lot. And so if you give them a list of 26 things to do, even if it's on a clear spreadsheet, they may not get to those last few items. So you want to attack the biggest and most important things first. And that's usually work orders, to make sure you establish a clear statement to the residents that we care and we're going to do things right. And even though there's a new kid in town, don't be scared. We're going to take care of the property. That's always the first. And then your 3 stakeholders, lender, insurance, and city, what they asked you to do. And then your CapEx plan, where it's going to make the biggest impact to the property first.
Mhm. Excellent point. One that you brought up, which is really very problematic, and we have seen it particularly with less experienced deal sponsors with multiple GPs on the team, where multiple GPs think that they should talk to the property management company, right? If you want to lose a property management company and their trust and their willingness to work with you, do that, right? Have multiple people on your team talking to different people and give them instructions what they need to do next.
That can be very confusing to the on-site, and you want to make sure it's one cohesive approach from your team to the property management company's bosses too, like all the way from top down, the vice president, the regional, and then to the on-site. You don't want to have different GPs communicating different things to on-site staff when they show up to the property or on calls. That's different from what you have communicated overall as your biggest strategy for the property through the property management company. So the regional and the on-site should all be having the same message and same priorities communicated as one clear priority message from your sponsorship team. So it's all cohesive. That's super important.
Yeah, definitely. You brought up insurance, right? Obviously, the initial part, it needs to comply, and typically that's not such a big hurdle to achieve because the lender has an insurance reviewer that makes sure that the
Mhm.
policies meet the lender requirements. Where very often things get messed up is with renewals, right? Where
Mhm.
a borrower decides, okay, now we review it. The lender doesn't engage an order insurance reviewer when that renewal takes place, and suddenly the borrower is no longer lender compliant, right? For whatever reason
Mhm.
that might be. There might be exclusions in the renewal of the policy. The deductibles might be higher than what is acceptable to the
Mhm.
lender, you name it. And you suddenly you think that you're insured, right? You mentioned that you may not have coverage, right? Which is obviously a big problem when you submit a claim, but it's also that the lender may tell you, sorry, you are no longer in compliance. And that can actually get to the point where the lender may claim that you committed gross negligence if there is a
Mhm.
claim that the insurance company is not paying. And a non recourse loan may now only turn into recourse, right? Because they tell you, sorry, but you didn't maintain the insurance as you were supposed to based on the loan agreement, right? Uh,
That's a scary prospect. Thank you for highlighting that. So at the renewal time frame, it sounds like you don't get the reviewer also from the lender side. So any changes in coverage, deductibles, etc., must be communicated before signing those agreements. So start the process, I recommend, is 60 to 90 days before that comes up, so that you have plenty of time to shop around. Maybe you're the existing insurer is not going to insure you anymore, and you got to shop and find a new insurance company. And so that process can take a long time. And then to get back as far as reviewing with the lender, you must send that certificate to show that you are fully insured to be compliant. So have
Yes.
all of it ready before that 12 months comes up.
That's right. Now, some lenders, they do the insurance review every single time, right? But
Mhm,
some do not. Do not
mhm,
assume just because the lender will so-called accept that new policy or the
mhm,
renewal that you're compliant. It's your job to be compliant, right?
mhm,
And so that's really important. One other aspect you brought up, the capex. Very often, what we see is with borrowers that they budget for the capex, but then they also, particularly if it's lender financed, right? That's particularly the case with bridge loans. Think, well, the lender is financing it, so I do not need to budget for it. Well, the problem is that the lender will pay you once you prove that the work is done, and very often you need to pay the contractors first before
mhm.
you actually get reimbursed, right? So
Correct.
together with interest rate increases, other issues, maybe lower occupancy and so on, suddenly operators no longer have the cash to pay the contractors. So then file a claim. The contractors are no longer willing to do future work until they get paid. So now you're in a situation where the lender is not paying you and you're not able to continue to work, right? Which obviously puts that property into a downward spin, which is the most terrible situation you can be in.
Yeah, another thing on that subject is when the lender is financing your rehabs, you actually submit to them a list of things you're going to do. And so later on, if you change your mind or do things a little differently, you still need an agreement from them to fund that. And lenders will send somebody to actually walk the units, walk the property before they will fund your capex projects. And if you didn't do exactly what was agreed upon, they may choose not to fund all of it, or they may say that was excessive. We will only fund a portion of it. And then the GPs are out as far as, having to fund that themselves or make capital calls, etc. I'm starting to see that a lot. So be very sure what the lender is particular about and follow exactly that process, or submit a change request if you're going to do something different from what you agreed upon initially as far as capital projects, if the lender is financing that for you.
Yes, excellent point. And I think to add to this, if you realize as you go through the rehab process that some of the rehab that you thought would be worthwhile to do but doesn't generate the bump in rents, go back to the lender and discuss it with them, right? Do not
Mhm,
just say, well, I do not need to do the
mhm,
unit rehabs because I do not get the rent bumps, or I get the rent bumps without the unit rehabs. Communicate that with the lender, right?
mhm,
Particularly in the current environment when you're already short on cash. You may have, particularly with a bridge loan, you may have to buy more another interest rate cap, and you need to use funds for something else. If you talk to your lender early on about these issues and discuss whether some of the capex that you originally anticipated to do, that might not be the best money spent, you need to discuss it with the lender and get the lender agreement rather than just deciding on your own, well, that's what I'm going to do. Right? So it needs both sides need to align to the new strategy if a new strategy may make more sense. And some lenders are willing to listen and be willing to pivot into a different direction, but you need their agreement. Don't
mhm.
just do it on your own.
Exactly. Excellent point again. And at the heart of it all, make sure your PM is executing to that strategy. So when you make these changes based on your communications with lender, etc., have a very clear communication path back to the PM team so that they're also doing the interior rehabs or exterior projects the same way that is compliant.
Uh, One question I have for you: how you've deal with delinquencies and low occupancies, and how you communicate with the property management side to ensure to keep occupancy high on one side, but also to still uh, bring quality tenants in that actually are able to pay. Obviously, everyone can fill a property to 100% occupancy, right?
Mhm.
But if you have a lot of tenants that are not paying, it doesn't really matter. So how do you work through that communication with your property management team so that they fill the property to the best possible to their abilities, but also keep the tenants out that are creating trouble soon down the road?
So the physical occupancy versus economic occupancy are two very key and different metrics. And economic occupancy is a factor of how much do you actually collect of what is billed, along with what is market rent versus actual rent, and all of those other factors. So the biggest factor is number one, when you screen the tenant to move in, make sure that their income can support your rent. So if your average rent you're going to be charging them is $1,500 plus utilities, etc. Then times 12, you're at 18,000 times 3x is 54,000. So if they only make $40,000, they're not going to be able to afford your property. And the minute they have one big expense like a car repair or something, they're going to be delinquent. So start at the level where their median household income is at least 3 times the annual expense of living at your property. And that's not just the rent, but also utilities and any other extra things you charge them for, like parking, pet, etc., etc. That's the number one. And how do you screen for that is you need to make sure. A lot of people are having fraudulent pay stubs nowadays. So make sure you do some screening. You have some software. So ask your property management company what they use. Snap is an example of a tool. The third one is, does it make sense in your demographic, etc., based on the local laws and courts for you to actually have some government paid Section 8 style of residence, just because you're going to get paid as long as they qualify for that property. So look into assistance programs available, because there are certain pockets that are, shall we say, more blue, where there are more resident advocates at the courts, etc., and fight for them. So help them. Let's just go find those assistance programs and make them aware so that we get paid, because we're not a free service. And then on the other side, for the delinquency itself, do you have programs like Rhino or Lease Lock, etc.? Some kind of a security deposit plan that's going to help you do a better job with the collections, especially if they skip and they have a large balance. Can you go collect that with these programs? Those are some of the things we do. But upfront, the biggest one is, what does your property management company do to do a better job of collecting on those delinquencies, right? So are they sending text messages? Are they using AI to automate some of those reminders, whether it's emails, text messages? We put a note on the door to say, hey, come see the property management company. And because it's red or pink in color, people know that means you have a balance owed. And it's sort of like, publicly tells them, look, you've got a problem. Tell us what happened. If you can work out with us a payment plan, that's great. But do what you say you will do. If you're telling me you're going to pay everything in full, you're just going to be late, but in 2 weeks, versus you pay me $50 when your balance is $3,000. Okay, that's not a fair payment. So work those details out with your property management company. One of the reports you want to be looking at is your delinquency on a daily or weekly basis. And so lenders want to know how much income you actually collected, not just what was billed. See if the incentives for your on-site can be targeted towards improving specifically that. I mean, if I remember the days when I was making $30,000 a year, $40,000 a year, and so every $50 mattered to me. So can you incentivize your on-site by telling them, I want you to collect 96% of what is billed, and then let's move that to 98% of what is billed, and incentivize them accordingly and make that the target. And these are some of the strategies that have helped us in managing that. I
Yeah.
have a property with $334,000 of monthly collections, and my delinquency is less than $1,000 at that property, which is just unbelievable, right? Like 0.3% or less kind of delinquency. I also have a property, where the collections are more like $200,000. The delinquency is in the range of $20,000, right? So You've got to figure out what works for each place, and therefore how to incentivize your on-site staff and have a stronger relationship with the residents so that they communicate to you at the onset of a problem. So during COVID back in 2020, when a lot of people lost their jobs because businesses shut down, we had a day set out where our property manager sat outdoors in this open courtyard with her laptop and 6 foot distance, and helped residents fill out their application forms to submit for assistance programs that were available at that time. And as a result of that, that property did so well. When we sold it in 2021, we actually tripled investors' money. And that was because we were working with these residents. We told them that we wanted to help them. We didn't want to have a large delinquency and for them to just hide from us. And so we openly discussed the challenges and found a solution that was a win-win on both sides.
Yeah, this is really an excellent point, right?
Mhm.
And you mentioned that you need to monitor delinquencies almost on a daily basis, right?
Mhm.
If the earlier you can uh, realize where there are some potential issues and address them, the better off you are, right? I mean, it's like the equivalent, right? If someone has a credit card debt, right? If it's a small amount, then they're still able to overcome that. But once it builds up and builds up, then they reach a point where they say, well, they're just tossing the towel and
Mhm.
are essentially are giving up. And very similar things happen, obviously, with when you're behind with payments
Mhm.
for rent, right? So
Yeah.
the faster one tackles it and
Mhm.
finds solutions with tenants, the better the chances are.
Yeah, and to be aware of how long an assistance program takes to pay, and to be able to quickly tell whether or not the resident is going to qualify. Because they'll say, I'm waiting on assistance, waiting on assistance. Well, did you really qualify? Do we have any documentation to show that you will be approved for that amount on your balance? And great that this program is covering you now, but what is your path? Like your renewal is coming up. If you stay here another 12 months, how long is this going to continue? What is your path to, being financially independent enough to pay for this rent and all your other expenses? And you
Yeah,
want to have those discussions by establishing relationships. So one of the things we do at our properties is have periodic resident activities. So next weekend coming up is Mother's Day weekend. So we hand out a long stem rose to every mom. And after that, we'll be having our pool party. So because it's Memorial Day is coming and it's a summer kickoff. So on a regular basis, if you're having activities and your on-site staff gets to have conversations with the residents, they get to know them well. So when their problems arise, the communications are easier and we resolve them quickly. And so it's all about having the best staff staying at your property for a while because they love working there. And that makes it more conducive for residents also to stay there and build a community instead of just being a transactional place to live.
yeah. And also when they have problems that they hide, right?
Yep.
Which is the last thing you want.
Yep.
Excellent point there. Maybe as a last item, what are your tips to work with investors and keep them happy? Obviously, you raise the money, which is there are plenty of people that talk about raising money, but not enough people talking about how to communicate with investors once the deal closes, particularly when there are problems. And you touched already on it, right, a little bit, but what are maybe some snippets where you can just mention what you think are kind of the core piece of what you think should always be in place to keep investors happy?
Ultimately, if you are delivering on your projections and making those distributions, most investors are completely fine, even if they don't hear from you as often. But the minute there is a problem, the minute they realize that your deal has some challenges, bridge loan, floating rate loan, whatever other challenges, you want those communications to be frequent and you want to minimize surprises. So if you think you're going to need to make a capital call, give yourself plenty of time. Don't just make an email announcement about it suddenly and say, by the way, I need your money by the end of next week. That's not going to happen because making a capital call is pretty much like a new raise. Now you're telling investors, I need you to contribute 10% more, 20% more, whatever that is. So it's like you have to prepare the webinar, you have to give them 60 to 90 days, etc. So communicate openly, clearly. If you messed up, like I messed up, I said, I messed up by buying a floating rate bridge loan deal. And now I'm scrambling to minimize the damage and get us on the path to recovery. They would appreciate that. Confess, it's okay. We all made mistakes. Nobody planned these unprecedented rate hikes, 11 hikes in a row like this over the last 2 years. And even the Fed doesn't know what they're doing. They told us at the beginning of the year they're going to cut rates, but they may not cut rates at all this year, right? So nobody knows what is going on. So what are you doing to mitigate risk and communicate that? And if you made a mistake, apologize. They already know you made a mistake. That's why your deal is in trouble. So go ahead and say that. That goes a long way in saying, hey, I messed up. I'm sorry. Here's what I'm doing to fix it. And I'm going to do my very best to fight this fight.
Excellent point. When it comes to the story, how to fix it, I think one of my pet peeves is that we see a lot of capital calls all across the board, right? And we see the communications. Then we talk to passive investors that tell us, oh, we got this capital call. That's the information that we received. And I'm shocked how many capital calls are being made without the deal sponsors actually coming up with a new pro forma and plan that shows that with that capital call, they actually have a path to succeed, right? So just because you say, well, we are in trouble and we need some more money, without actually showing a path to success, why would anyone be willing to
Correct.
bring in more money, right?
Exactly. What is this capital call for? Is it to buy an extension of your rate cap, or is it to help you refinance into permanent debt? Okay, now that you have refinanced to this permanent debt, what is the decrease in your mortgage payment? What does that look like 6 months and 12 months into this new refinance deal? And what does it mean in terms of cash flow as well as the future path to exiting the deal? So it's like a brand new underwriting and a brand new webinar, and that's how you should do it.
Yeah, absolutely. Sandhya, thank you very much for your time and expertise here. Asset management is so important, and again, a lot of people confuse it with property management.
Yep.
And it's more important than ever in the current environment. So I really appreciate all the efforts you put into that. Why don't you talk about the event that you have coming up on May 10th? That is specifically helping multifamily operators to improve their asset management.
So I'm hosting the industry's first one-day in-person event focused exclusively on multifamily asset management. So what happens after closing? Because a lot of glamour goes into the acquisition phase, but nobody's really talking about asset management. And ultimately, the way you raise capital from investors is by coming through on your projections. And you do that by managing assets effectively. It's a one-day event. We'll have a few guest speakers, but most of it will be the asset management from soup to nuts of what is involved, a more detailed explanation of the things we covered in this podcast. Would love to see anyone there who needs help and who wants to manage their assets more proficiently. A lot of people go in as co-GPs and raise money and are gone with the wind. And now the deal is in trouble. They don't know where to start debugging a problem. So it's happening on May 10th in Dallas in the Richardson area. aceoperators.com is my website for my operations mastermind. And that's where you'll also find the details of this event to sign up. So thank you for bringing that up, Antoine.
Yeah, you're welcome. And so if someone wants to reach out to you other than aceoperators.com, I'm sure you're very active on LinkedIn, on Facebook, right? It's not difficult to find you.
Thank you. Those are the two platforms where I post. So best place to find me. And of course, through Anton, you can find me.
Yeah, definitely. Thanks again, Sandhya, for being with us today and adding all value about asset management.
Thank you very much for the opportunity and look forward to seeing you again at a future event.
Yeah, same here.